Supply Chain Finance by Lukmanur Hakim from Trisakti Institute of Transportation and Logistics. Supply Chain Finance, or SCHIF, is a financial practice related to managing financial flows in a supply chain. This involves collaboration between suppliers, manufacturers, and buyers in order to improve financial efficiency and optimize working capital in the supply chain. Basic definitions and concepts. 1. Supply chain. Supply chain is the network of entities involved in producing and providing products or services to the end consumers. 2. Finance. Finance is the study of how organizations manage their assets and liabilities, including cash flow, investments, and financing. 3. Supply chain finance. Supply chain finance is a financial approach that focuses on optimizing financial flows within the supply chain to improve efficiency and financial performance. The purpose of supply chain finance is improve liquidity, reduce finance cost, optimization of working capital. Improve liquidity is one of SCHIF's main goals because sufficient liquidity is very important in maintaining the smooth running of business operations. SCHIF enables suppliers to gain fast access to funds tied up in long cash cycles. Usually, suppliers must wait for a credit period specified by their purchasers before accepting payment. With SCHIF, suppliers can sell bills to financial institutions or use other financial instruments to get cash faster, helping to increase their liquidity. Reducing finance costs aims to minimize costs associated with financing, borrowing, and other financial activities within SCHIF. In SCHIF, suppliers can access financing through financial institutions that work with their buyers. This allows suppliers to gain access to funds at a lower cost than traditional loans, which may have higher interest rates. By reducing borrowing costs, SF helps increase supplier profitability and reduces the financial burden they must bear. Components of supply chain finance. First, supplier. Supplier is an entity that provides goods or services to manufacturers or distributors in the supply chain. One of the key components of SCHIF is the ability to offer suppliers early payments. Within the SCHIF framework, the buying company can pay the supplier earlier than the maturity dates specified in the payment terms. This provides direct benefits to suppliers by increasing their liquidity and enabling them to better manage their cash flow. Second, buyer. Buyer is an entity that buys goods or services from suppliers in the supply chain. One of the key components of SCHIF engaging buyers is the ability to extend payment periods to suppliers. Using F, buyers can enter into agreements with suppliers to extend payment terms, giving them flexibility in cash flow management. This assists buyers in maintaining their liquidity and optimizing the use of working capital. Third, financial institutions. Financial institutions such as banks or finance companies that provide financial solutions to facilitate financial institutions play a role in providing financing to suppliers within the framework of SCHIF. They can provide financing based on invoices submitted by suppliers to buying companies. By using this financing, suppliers can access cash faster and increase their liquidity. Financial institutions analyze credit risk and set appropriate interest rates and financing terms. And last, financial instruments. Financial instruments used in SCHIF include factoring, discounting, payment extensions, and international trade financing. Financial institutions play a role in providing financing to suppliers within the framework of SCHIF. They can provide financing based on invoices submitted by suppliers to buying companies. By using this financing, suppliers can access cash faster and increase their liquidity. Financial institutions analyze credit risk and set appropriate interest rates and financing terms. SCHIF models are divided into 4. There are reserve factoring, approved payables, inventory finance, and payables discounting. Reverse factoring. The buyer helps the supplier obtain financing by confirming invoices accrued by the buyer to the financial institution. Approved payables finance financial institutions finance bills that have been authorized by the buyer and are due within a certain time. Inventory finance. Financial institutions provide financing based on the value of inventory held by manufacturers or distributors in the supply chain. Payables discounting. Suppliers sell bills to financial institutions at a discount to get cash faster. Benefit of supply chain finance. A. Improves liquidity. SCEF enables suppliers to gain quick access to funds tied up in long cash cycles. By accelerating payments or using financial instruments such as factoring, suppliers can increase their liquidity, reduce the need for additional borrowing, and reduce financial risk. B. Optimizing working capital. SCEF helps companies optimize the use of their working capital. By extending payment periods to suppliers or using solutions such as reverse factoring, companies can extend their cash cycles and improve working capital efficiency. C. Reduce financial costs. SCEF can help reduce financial costs in the supply chain. By using financial instruments such as factoring or discounting, companies can obtain funds at a lower cost than traditional loan interest. In addition, by optimizing cash flow and working capital, companies can reduce excessive inventory holding costs. D. Improve supplier relations. SCEF can strengthen the relationship between a company and its suppliers. By providing faster access to funds, companies can build stronger trust and partnerships with suppliers. It can also help strengthen supply chains, improve product quality, and reduce supply risks. E. Reducing credit risks. With SCEF in place, credit risk can be shared between companies, suppliers, and financial institutions. Suppliers can reduce credit risk by using confirmation of invoices from buyers, while buyers can reduce supplier risk by providing access to affordable financing. Financial institutions can also help manage credit risk by conducting credit analysis of buyers and suppliers. If improve operational efficiency. By accelerating financial flows and increasing liquidity, SCEF can improve operational efficiency throughout the supply chain. In SCEF, payments can be made more quickly, inventory can be circumvented, and transactions can be completed more efficiently. This can reduce cycle time and administrative costs, increase productivity, and reduce waiting times in the supply chain. Thank you for watching.